Welcome to our second session today regarding the PPP program's interim final rules on loan forgiveness that were issued by the SBA on Friday, May the 22nd. Now, for those of you who've been around with us for a while, you know this is the second time that the SBA has issued these rules here in the last 2 weeks. We've had late Friday night issuance of something. Previously, we had the application form that came out, but this week we ended up with not just an application form, but actually some true final guidance from the SBA. And our guidance related to essentially two key pieces of guidance on Memorial Day weekend just before it got started. The first one was the Business Loan Program Temporary Changes Payback Protection Program Requirements Loan Forgiveness is the title of this particular IFR. And what this IFR does is looks at a couple of things. It is the official guidance on loan forgiveness, and it takes a look at a lot of things that are clarifying things that went on in our final guidance. So we had some clarifications of things that happened previously. So what we had was, I shouldn't say final guidance, we had in the application form. So the application form told us some things. This tells us a few more things. Then at the same time that evening, we had issued another set of guidance, which was related to reviewing the loans. Now this relates to the issues that when the banks go ahead, when the SBA reviews loans. If you remember, the SBA told us that they planned to review loans. And review those loans that were over $2 million would have specific reviews. This tells us something about what the SBA will do for those reviews, as well as the fact that they could review and plan to review some loans that are below $2 million. And while those loans are exempted from the good faith certification that they had a need for the loan, that doesn't mean they're exempted from everything. There will be some issues they have to deal with. So it ends here and tells us how the SBA is going to do their reviews. It also outlines what lenders are supposed to be doing in these programs. And that could be important because all of our clients, regardless, or all your businesses, regardless of whether the SBA reviews their loan, they're still going to have the lenders are going to take a look at their loans and have to figure out if the lender agrees with how it's been treated at this point. Now, this has a number of provisions that add to the application form or added in that initial, the forgiveness interim final rule, the first we're going to talk about here. So this adds to things that were in the application forms are clarified. They're going to tell us the treatment of the portion of the loan not forgiven. So if let's say your business or your client is not fully forgiven the loan, how do we treat that? We're going to find out that it implies that we get essentially the 2 years 1% on that. There had been some discussion that it might be a little less generous than that. We're still not clear though what happens if it turns out they decide that you got a larger loan than you should have. Are they going to demand that back or not? Again, no direct discussion of that point. We also have some more clarifications on this whole issue of what were the rules around incurred and paid. The good news is for non-payroll expenses, we have the first example that clearly shows we can get more than 8 weeks worth of expenses. In fact, the example that they have gets us just short of 3 months worth of electricity bills into the 8-week period. And it's our example. It tells us that literally this is how that's going to work. So that's good news for the first time. We also have some clarification. Remember on the original application, we got this new 3 categories of owners. And that was important because owners have certain special treatments. And what was concerning some people is what's this category called owner employees? Is it really just something equivalent to what we see in Section 401c3, which is basically going to be the deemed employees for qualified plan purposes, which would normally be a self-employed individual, partners? Or does it mean, which others thought, and I thought was probably more likely reading, that this was shareholder owners, those who are not self-employed but are in the other category? This particular guidance doesn't come out and say shareholder are who we're talking about here, but it definitely tells us there are different treatments for this class than the other two, which implies by definition this is a different class that does not include owners of a Schedule C, so the owner, the proprietor, nor does it include general partners in a partnership. So ultimately, we're running out of things that could be other than shareholder employees, so we think it's shareholder employees. That's not good news because, as we talked about last week in our session where we discussed the application form, these individuals, these owner employees, are going to be subject to an 8/52 of 2019 compensation cap that will not apply to rank and file employees. So that's, if you're going to bonus out the owner, that's not going to work well. And if your only employee is a one-person S Corp or C Corp and that's the owner, then yeah, we've got a problem here that we can't really do anything different. We also discovered that we had a clarification limitation on retirement and health plan benefits for owner employees. It's not totally clear what this means because it's worded a little differently, so we'll have to take a look and figure out what exactly that means. We talk about owner employees and what owner employees are going to be for this purpose, but it does suggest strongly that we do get some benefit for that. However, whether that benefit is part of the 100,000 annualized cap, the 15,385 maximum payment for the 8 weeks, is another question entirely. You certainly can read it to suggest that, yeah, we're going to have to worry about that cap. It tells us also about added new. You remember a special rule was put in place. If you offered an employee their job back and the employee turns you down, that you would be able to take them out of your FTE calculation. Found that out with the application form, exactly how it's going to work. What we didn't have at that point, but we have now, is you're going to have to inform the state unemployment department that the employee did not accept the offer of employment back. That was something I had suspected would be a side part because this was all brought in because of the problems we had with unemployment and the fact that workers did not want to come back because they were going to take a pay cut if they went off unemployment. And who's in today's world who would volunteer for a pay cut? So they're not going to do it. But now it's very clear if you want to use those funds, not only do you have to make the written offer, not only do you have to have the employee reject you, but you're then going to have to forward that information in some way, shape, or form to be announced later to the state unemployment department. That may create issues that some employers are not going to be happy with. We also had the addition, this is kind of nice, we have some safe harbors to protect an employer from full-time employee problems, FTE, full-time equivalent I should say, problems related to the actions of an employee. And you're going to find out that there are 3 categories there that are considered employee actions. That includes an employee who is discharged for cause. We don't have a good definition of for cause, but we have that. An employee who resigns, got a better offer somewhere else, or it was like an intern who was working for you over the spring, but now they've got a new internship. They just, or they've gone home for the summer, they've resigned, they quit their position, or you have somebody who asked you to reduce their hours. For whatever reason, not related to coronavirus, they just don't want as many hours that they had before. We're going to get some exceptions to that. So let's take a look at some of what we got in this guidance. One of the things we got was a full definition of costs. It's in, of all things, a footnote, but we got a full definition of what was included in payroll costs. So payroll costs we got a full definition of here. And what it tells us is a few things are in there. And it tells us salaries, wages, commissions, or similar compensation. Nothing terribly surprising that that's part of it. It does, however, give us some information on cash tips. Cash tips are the equivalents. Now, the problem with cash tips is very simple. Cash tips are normally paid by the customer. The employer doesn't really always know what those tips are. So what it tells us is, because we can't know it, we can base it on employer records of past tips, where if there are no such records, a reasonable good faith employer estimate of the tips involved. Why tips are important is because they become part of payroll costs. Things that are part of payroll costs become forgivable portions of the loan. They also become part of what we have to match, right? When we can't have a reduction from prior amounts paid, those are going to be in the non-reduction area, so we've got to worry about what those are. Any payments for vacation, parental, family, medical, or sick leave. Again, nothing new there. We also had an allowance for separation or dismissal. Those were words, these are all words we had in the original law. We had these in the prior guidance, so none of these really surprise us much that we have that. We had the payment for provision of employee benefits consisting of group health coverage, including insurance premiums and retirements. Again, nothing new. We had the payment of state and local taxes assessed on the compensation of employees. And we have, for an independent contractor or sole proprietor, wages, commissions, income, or net earnings from self-employment or similar compensation. This one's a little bit more unusual because independent contractor wages, it's not totally clear what's meant there as to that sort of thing, what that means from that standpoint. It's, are they trying to indirectly refer to statutory employees? You just don't know what's in that mix. But it does tell us those are payroll costs. And to be honest, remember, one of the things you may read into this is, since we have to have a payment of payroll costs, it could very well be that we have to have some sort of payout, shall we say, of those items during the terms. But net earnings from self-employment, one of our key unanswered questions that remains unanswered is, if you're a Schedule C business owner, do you actually have to take a payment of 8/52 of last year's Schedule C earnings out of some place, take some money out of the loan, somehow document you did it, or do we just get that 8/52? This might imply we just get it. But I hate going with implieds on things like this, because things that are implied, if it's not actually meant the way you thought maybe it does, well, that creates problems for you. Secondly, we go on and we have a definition of non-payroll costs. What are non-payroll costs for this purpose? And non-payroll costs include interest payments on business mortgage obligations on real or personal property that was incurred before February 15, 2020, but not any prepayment or payment of principal. Now remember, loans have always been a little different. And in fact, what's interesting is if you go to the section 1102 as to what you can use funds for, it tells you can use it for interest on a mortgage, but also says other interest. While you can use it under 1102 for other interest, under 1106 for forgiveness, that last thing, just interest on other loans, which I assume has to mean unsecured debt, that's not an allowable use for purposes of getting forgiveness. So I assume what we mean by this is if it's secured debt, so I have money I borrowed to buy a piece of equipment secured by the equipment, that will count. But if I went out and used an unsecured line of credit to buy the equipment, then that interest probably won't count. So you have to worry about how is it set up. What did we do? Any payments on business rent obligations on real or personal property under a lease in force before February 15th of 20. This is something we've known about before. Now remember, it is real or personal. So if you have somebody renting a bunch of equipment, that counts too. The other neat thing we haven't had any clearance on here yet, got to remind you there's nothing in this as well. What about rents paid to related parties? There's been nothing I have found so far that suggests that anybody's addressed the related party rent issue, which is interesting because in many cases we have a building that has a mortgage but it's owned by the owner, not the business. And we turn around, it's owned by the, let's say, the 100% shareholder, not by the S corp. We pay rent to that outside, that individual. It appears we get that rent. I mean, not totally clear, and we'll have to watch what that all means. We also have business utility payments for distribution of electricity, gas, water, transportation, telephone, or internet service, for which service began before February 15th of 2020. As we know, that's all the standard list. The only description we had of transportation goes back to the interim final regulations that we got on the self-employed. That's where we finally saw gas for business vehicles are in there. Payments, various other expenses related to business vehicles are part of transportation. But otherwise, we didn't really have anything to tell us what was transportation. So, the best we can do is go back there. But yeah, things like gas, fuel, maintenance would appear to be fine on business vehicles. Non-payroll costs cannot exceed 25% of loan forgiveness amount. key thing to emphasize here. A lot of people got very worried because some banks had said that if you got a loan, you had to spend 75% of the loan proceeds on payroll costs. And if you failed to do so, none of the debt would be forgiven. Key point I want to make here, make it very clear. Nothing in the application or these final regs, or these interim final regs, nor any other document we have seen from the SBA that is either official IFRs or even the unofficial, close to official FAQs have ever said anything of that sort. You will only get a cancellation of debt or a forgiveness up to essentially, the amount of payroll costs divided by 0.75. So that payroll costs are 75% of the forgiveness, no more than that. But if you fall $1 short of 75% of the loan proceeds, you are not going to lose the entire cancellation of debt. We have seen nothing so far that tells us that the SBA is going there. There was a lot of concern. It was based on, as best I can tell, a single email from a single SBA office that suggested this was how it was going to go. Okay, now let's talk a bit about the loan forgiveness process, right? That's the next section they came into. What they discussed there, there will be, and we'll talk about this a bit later, there is a separate interim final regulation that will deal with how the SBA will review loans, how the lender will process applications for forgiveness. We'll talk about that after this. So that's not part of this particular IFR. It says basically at the end of the loan, once you're done and you're ready, you will complete and submit the loan forgiveness application, which is the form 3508 that was released last Friday by the SBA, or a lender equivalent. So you may find that Chase or Wells Fargo, Bank of America, whatever bank you've used may have their own form, but you are going to have to submit that form, that form or an equivalent. The lender will have 60 days to make a decision. So the lender has 60 days to decide, should you get a loan forgiveness, should you not? So as I said, this has also been clear from the beginning. The first decision for forgiving debt is going to reside in the hands of the lender. Your application for forgiveness does not go directly to the Small Business Administration. It's going to be you and your bank first dealing with that issue. Once the bank decides that you should have at least some of it forgiven, or whatever they decide, they then forward the file on to the SBA. The SBA has 90 days to approve or disapprove the lender's decision to forgive your debt. Now that's important because you have to kind of add these two together. If the bank has 60 days, the SBA has 90 days, it could take 150 days before you're actually going to get a notice of whether you've been approved finally for forgiveness, if the SBA chooses to review your documents, right? If the SBA decides to disallow, whatever is decided, disallow some, allow some, whatever goes on, the lender is the party that will inform you. So you're not going to get a letter from the SBA saying that your application was approved, your application was disapproved. The lender is going to give you the SBA's truth. Now, because it's going to take 150 days, it is very possible, and this you need to understand too, that you may have to start making payments before such time as you're told whether your loan is going to be forgiven. If that has happened, and the SBA pays principal in excess of principal currently due, then the excess goes back to the borrower. With 150 days to process this, there's a very good chance in a lot of cases we will have at least some principal going back to borrowers once this is done. We'll see how that process gets running, but it clearly is an issue we need to worry about. The next thing that the regulation goes on and talks about is the idea of costs that are incurred and paid. It starts talking about payroll costs. And the first thing we get in the payroll cost section is the fact that we have a choice of our covered period. We can take the standard covered period, which is the 56 days from the day the money goes into the bank, or we can wait and start our 56 days for payroll on the first pay period that starts after the money's dropped in the bank. Now, you actually, as we noted last week, you put that choice on the application form. You tell them which one you're choosing. In many cases, it will be better to delay because, as will probably become clear, it seems highly likely that if you delay, and if you're like most companies, you pay your payroll a couple of days after the pay period ends, that you will effectively be able to very easily get 10 weeks worth of payroll in the 8 weeks period. Because what we have to look at here is how the definition of incurred and paid go. Remember, it says costs incurred and costs paid, no duplicates. So you pay a payroll on the day paychecks are distributed, or you, the borrower, initiates an ACH credit transaction to move the money into your employees' bank accounts. Like I said, usually if your pay period ended last Friday, and so you're starting your period on Saturday, you probably are issuing paychecks sometime in the week that's going to start beginning Monday. Let's say you issue paychecks on Wednesday. Those all will meet this requirement. They will all meet the requirement to have been paid inside the 8-week window, because the 8-week window is already underway by the time that those checks are paid. As such, those should count as payroll paid. And we'll have a series of those, right? We're going to have, so if that one's paid, and we're every 2 weeks, we're going to have 3 others paid during the 56 days. But then when we get to the end of the period, we're going to end up with this costs incurred situation. Costs are incurred on the day the employee's pay is earned. So in my example, the last 2 weeks of the 56-day period, we're going to have costs incurred during that period. Now, those costs would be paid normally on the Wednesday following when that 2-week period is going to end, when that 8-week period is going to end. But the way this will work is as long as we pay them, right, it'll work for us, right? It'll be that way we get it paid. And here's the other interesting aside. A lot of people are concerned about this. What about employees we are paying right now, we put on the payroll, but we can't work right now because we are under a shutdown order, or we've just decided that, there's no point. I was reading I've read more than a few articles about restaurant owners who have said that, they're in an area where they can have 25% or 50% of capacity. And they've said flat out, there's no way that works. I mean, we are paying rent as a sit-down restaurant. We're essentially, and I think it's always been true in the restaurant business. To really understand the restaurant business, especially for a sit-down restaurant, you are renting space. That's a principal thing you're doing. Anything you're paid by the people eating in the restaurant has to go not only to pay for the food and the waiter and the cook, it's got to pay for the rent in the building because they're taking up space. As long as they're taking up space, nobody's buying another steak, right? We need to get them out of, so how much the steak costs depends to a certain extent about how long the people eating the steak are going to be at that table. Now, if I take half the tables out of commission, and I've either got to greatly increase my price, or I'm going to lose money. Now, in many cases, you're going to have people who are taking the PPP loans. They have only half the capacity. There's no reason normally to have additional staff there who won't be able to serve anybody because we can't do half the tables. Well, this makes it clear that if you're in that position, if the employees are not performing work pursuant to your payroll, they're based on what we would have expected them to work. So if they were expected, so the good news is I can still get them incurred in that last 2 weeks, even though they may not be on payroll, right? And that's the key, because if we're incurred in the last pay period, the covered period, or the alternative period that are eligible for forgiveness, it paid on or before the next regular payroll date. So that's the key takeaway. So back to my example, I had those one payroll that came from before, the period began, all the work's done before, that counts under paid. The next 3 are both incurred and paid, and the final payroll is incurred, and as long as I pay it on that following Wednesday, that will count as well. I do the math. I have 5 payrolls that count for this purpose, and I cover 10 weeks of actual work inside the 8-week period. Now, caveat with that, I am still going to have to worry about the cap of $13,585 for any single employee over that period, and I'm still going to have, we get to owners, the 850 seconds cap is still going to apply. It will not be 1050 seconds. So those hard and fast 8-week rules for the cap on $100,000, ratcheted back to 8 weeks, or the cap on the 850 seconds of earnings, those still stay in place. But if you have rank and file below that level, then yeah, we can make this work. This will work pretty well. So that's kind of nice that we can do that. The one key, as we said earlier, though, you can't duplicate costs. So that example is pretty easy. Remember those 3 payrolls in the middle? We both incurred the expense and we paid the expense within the 8 weeks. I don't get to count them twice. Once is incurred, once is paid. They count only once. But it does allow me to go back and pick up those that are paid but not incurred during the 8-week period, and those that are incurred but not paid until the first payroll after the 8-week period. I can get all of those in with no other problems. Now, another concern some people had related to, well, do we have to just pay people their regular salary? And the answer is, for non-owners, the answer is pretty much no. We don't have to pay them there. We actually can pay them above that level and will not be penalized. If we pay furloughed employees their salary, wages, or commissions, those payments are eligible for forgiveness. I've had more than the thing I got all the time is questions. Well, we got the loan, but my client's business is closed, so we can't pay anybody. The answer is, and it's been true since day one, you can pay somebody. Pay them to sit there and contemplate the future. Pay them to sit there and come up with plans. I don't care what you call it, but you can pay them. And as this makes clear, you can pay them for nothing. The federal law does not care. That's the whole point. They will count for this purpose. If you remember the reason for this law, it makes perfect sense. It is a paycheck protection program. It is not meant, it's meant to protect their paycheck. We're not caring. The whole reason we have this is because we know there's not enough work for these people. We are trying to keep them on payrolls, and that will mean paying people for doing nothing is one of the things we end up doing. So that's just how it works. So that part's non-surprising. It enabling borrowers to continue paying their employees even if those employees are not performing the day-to-day duties, whether due to a lack of economic demand or public health considerations. So yeah, we don't care why. Just pay them. Just pay them. That was the key for this program. Now, that may change with law change. We'll see what else happens, but the law change is pretty easy. The whole intent was reflected throughout the entire statute. So you can go ahead and you can pay bonuses during this period. You can replace the commissions that somebody would have been paid. Because let's face it, if you're a retail operation and you're closed, your salespeople are not earning commissions. But you can still, out of the PPP funds, pay them the commissions that we expected they would have earned. That's the whole point of this bill. Okay, it makes perfect sense. You can also pay, they made it very clear at the very end, that you also could up somebody's pay and pay hazard pay. That's not going to be a problem. Bonuses are not a problem. The only problem is going to come for that owner. As we'll discuss, what we cannot do is bump up the owner's compensation. That's the one place we're going to find out that we're going to be blocked. The owner's compensation is going to be limited to 850 seconds of what they got in 2019. That was put on that application form, you remember. We knew that was true of Schedule C businesses. What we didn't know was how it was going to impact like S corporation shareholders, C corporation shareholders. Now we have an idea of how that's going to work. So that's the issue, which gets us to the key issue here of the owner's payroll cost. And the owner's payroll cost was, remember, added right at the end of the first, it was added on the application form. We had this new thing talking about owner's payroll costs. And the amount of the amount of loan forgiveness requested for owner employees and self-employed individuals' payroll compensation can be no more than the lesser of 850 seconds of 2019 compensation, which is approximately 15.38% of 2019 compensation, or the $15,385 per individual in total. Now, this one is interesting. It's the first time we see anything like this across, as I've underlined on the screen, all businesses. So what does that all businesses mean? That implies that if a person is an owner of more than one business, there's going to be an aggregation test here, at least for the 100,000 cap. So how that appears to read is, for every business you're involved in, 8/52 of your compensation from last year is your cap. But you also have to look at if there are multiple businesses that you're working in and you've got multiple PPP loans, you can't take more than $15,385 out of all of them. This is the first time we saw any sort of indication that we were going to have a cap that was going to be applied to compensation that was going to look across related companies. Previously, nothing had said that. That is disconcerting because we've yet to see anything, like I said, about payments of rents to related parties. This suggests that new guidance at some point could suddenly tell you, nah, that's going to be limited. We're going to kind of watch for that because we think that could be abused. Don't know they'll go that route, but they could. Now, the key thing that got everybody going, we talked about the actual application form, was this category of owner employees. Okay, and we had lots of discussion as to what it could be. Some people thought that owner employees would be things like would only related to the old 401c3 definition, and that's for qualified retirement plans for owner employees. The one place really we've ever seen that term directly used, owner-employees, is for like self-employed individuals and partners when we're talking about a qualified retirement plan. And that's the one place we saw this term was used. Well, I never thought that was the way the SBA meant to use it because it's a rather obscure reference in a totally different section of the U.S. Code that's never used again, and itself tells you it only applies for that particular section of that particular title of the U.S. Code. So I didn't think it was there. It turns out pretty clear now it's not there. Why do I say that? Because we have a different rule here that will apply to these people than applies to the partners or the sole proprietors. Owner's compensation for these people is capped the amount of 2019 employee cash compensation and owner retirement and health care plans made on their behalf. Now, it's not clear if the 13,385 is capping all of that, but it kind of seems they are. So it would seem like what you're going to have to do for this class is you're going to add up their entire compensation, right? The 15,385, you're going to add up their cash compensation, the retirement plan amounts made for them in 19, the health care paid for them in 19, and then you're going to go 8/52 of that, and you're going to compare that to 15,385. If that's more than 15,385, then you're going to have to cap all of those payments 15,385. If not, they'll be your cap. Now, it's possible the 15,385 does not apply to that. And again, first time I read it, I thought it didn't. The second time I read it, I thought it did. You want to go back and read that rule. To me, it's not 100% clear which way they intended that to go. But there definitely is that cap. And because this is the only place we refer to that type of compensation as the only place they're thrown in, and they're not thrown in the other two for reasons they explain that they're already counted, it's got to be shareholder employees. That's the only category that would not include, that would in essence be able to add that on. So I think the arguments that this doesn't cover shareholder employees are now pretty much dead. Otherwise, you've got to explain to me who could it be covering. And I don't think there's a good explanation as to who it would cover considering the justifications that they give here. Now, sole proprietor and self-employed, we knew that already. It was going to be 8/52 of the 2019 net profit. They don't get to count health insurance. They don't get to count retirement plan numbers. The IFR explains this one explicitly. Those amounts are paid out of their net self-employment income. This is what I thought the defense was going to be when we first saw it. Because the retirement plan and self-employed health insurance are deducted as adjustments to income outside of the Schedule C. They're saying, no, you don't add them back because they weren't netted to begin with. So those costs don't count. We're giving you what we're giving with the 8/52 of the 2019 Schedule C income. That actually includes all of those costs. So no, you can't add those back on top. You're going to have to just live with that. Now, as always, the last thing we ever get to find are partners. And this is our partners definition for general partners. They're capped at their 2019 net earnings from self-employment, reduced by claim, Section 179 expense deduction, unreimbursed partnership expenses, and depletion from oil and gas properties, multiplied by 0.9235. Now, that particular definition, if you take a look at the partner's instructions to Schedule K1, the partner's instructions to Schedule K1 tells the partner to take line 14's numbers, net earnings from self-employment, from the partnership and reduce it by the very things we're talking about here. So you'll have to go to the partner's return. How much of the 179 passed out did they get? How much did they get of, how much do they have any unreimbursed partner expenses they're claiming? And do they have any depletion? And you have to adjust SE by that. So it'll be basically the SE flowing through onto the eventually Schedule SC on which to pay self-employment tax. You then again multiply that by 9235. This is different than the self-employed. Again, there is an odd explanation I've seen run from the law as to why it would be different, but to me it's odd. Certainly it doesn't seem to make much sense from any sort of policy standpoint why it's different, but it is. And again, don't get health insurance, don't get contributions to plans. The justification they give you in the IFR is identical. It's already in their net. They don't get accounted again. So we can't take those expenses a second time. For non-payroll costs, again, we can count them if they're paid during the covered period or if they are incurred and paid by the next billing date. This is the same exact outcome, same exact way we've written it for payroll costs, right? The same pairing of options. And in this case, they give us an example that makes very clear. They have a period that begins that begins with the payments in June and ends in July 26th. And they end up getting, with the example, they pay the utilities for May in June. Again, none of that was incurred in the 56-day period. They pay the June utilities in July. Well, that's both incurred and paid. And then they give them the 26 days in July, even though those 26 days in July, they're not going to pay them yet. They won't be paid until August. So we're getting here nearly 3 months worth of utilities. This is the one time they make clear it works. So yes, you go beyond 8 weeks with the incurred and paid. We put more than 8 weeks expenses into the 8 weeks. That is intentional. You still got to worry about the bottom line as to, the caps on 13,585 or 13,585, 15,385 I should say, for the total compensation. That cap still worry about, but otherwise we get it. The example that's in there very clearly with the underlined part on the screen, it tells you you can get the forgiveness for May and June electricity bills because they were paid during the period, and you get the July bill. Like I said, that's nearly 3 months and 8 weeks. And I got news for you. Basic math, basic calendar math. 8 weeks is not 3 months. 8 weeks is much shorter than 3 months. So we no longer worry about that side of the equation. Now, the other thing they do make clear, though, there is one exception to the paid and incurred. Advance payments of interest on a covered mortgage obligation do not get loan forgiveness. So if you try to prepay the interest for the next 6 months, that does not work. That leads to an obvious question: could you prepay other things? Well, one argument is, sure, why not? They're not barred. But the other side of that may be, I think you may have a problem with that if legally the party you're paying them to would have to refund you the funds if in fact you don't actually make use of whatever you're prepaying for. So that could be more just a deposit. I would be very leery, especially because we have so many ways to expand the 8 weeks anyway. I wouldn't go to prepaying things until I'd exhausted the other alternatives. Because even though, the argument's there that it shouldn't matter because there's no statutory bar and they put a bar in for this. So if they wanted everything barred, they'd just barred everything. I don't know, though, still that it's not going to be a problem, especially if you go too far. I would limit the use of that dramatically if you want to use it. Now, they also talk in the IFR about reduction in forgiveness amounts. They talk about maintaining the level of full-time equivalent employees versus the reference period. And again, they remind us that our reference periods are a choice of 3. And also that no more than a 25% reduction in annualized salaries or hourly wage amounts for each employee. So we have an FTE test and a salary wage reduction test. These are the 2 tests that are computed on the application form. And they're not really doing anything in this IFR to change the basic application. They are doing some exceptions, and they added 1 new exception that's there. Now let's talk about the first exception. The employee won't come back to work. Right? The employee turns down rehiring. You offer the employee money at their job, they don't take it. You can avoid counting that employee as part of the FTE calculation if you meet the following requirements. First, you have to have a good faith written offer to the employee to rehire them. We knew that from the application form. The offer has got to be for the same salary and wages and the same number of hours as earned by the employee in the last pay period prior to separation or reduction in hours. That's also, we knew that from before. You finally have to have the offer rejected. You have to document that rejection to show that the offer was made and it was rejected. But a brand new thing, brand new, never mentioned before, mentioned now in the IFR. You must inform the applicable state unemployment insurance office of the rejected offer of reemployment within 30 days of the rejection of the offer. And the SBA will tell us at some point how we're going to do that, right? The SBA has said they'll provide guidance later on reporting. Okay, 2 key issues here. First, a lot of employers are going to be somewhat uncomfortable about this turn them in requirement. Why? Employee relations, even with employees that are currently working for you. It's going to be that apparently you cheated them. Believe me, how the story is going to get out, we know what's going to happen. Why do we have this problem? Mentioned it last week. The $600 add-on was the average shortfall between what you can get on unemployment and what the average worker was earning. The problem is average does not mean that everybody was 600. And in fact, the majority are more than 600 because we get the difference, which people always confuse, between the median and the mean. And if some people have a much bigger difference than 600 at the high end, which they do, then that means that there could be a whole lot more people below 600 in difference because their difference isn't as big. And that 600 is going to push them over. So studies, as I think I mentioned a week ago, about 60% of employees are making more on unemployment than they would make working. That's made rehiring them difficult. Turning them in, like I said, there's that problem of just employee relations, the uncomfortable thing, the fact you're going to effectively threaten the employee. If they don't come back, I'm turning you in. You can imagine all kinds of ways that's not going to make certain people feel comfortable. And they are not going to like it, especially if you're not a conflict person. Could create issues. But it is there. It was added. We had never seen that before. I think it was added late because somebody got upset of saying, well, you wrote this in, but then on your application form, you never said they had to tell anybody. It's like, well, that's just asking for fraud. Just ask people, we'll make this agreement. I'll offer you the job. You turn me down, and then I get to keep the money. You get your 600, and we're all happy. If the employee does this, though, if they turn you down, you basically take them out of the FTE calculation entirely, both when they were there before, in both periods, unless you replace them. The application form said you didn't worry about this thing if I hired somebody to replace this employee. Then I still counted everything, right? So we have that particular issue. We also have discussions, as I said, the reference periods. We'd already mentioned, and this was in there, that you had your choice of 3 different reference periods. February 15th, 2019 through June 30, 2019, January 1st, 2020 through February 29, 2020, or you had that 12-week moving period. That's part of the standard thing we talked about last week. Compare this to the average FTE for the selected covered period. You remember you got a choice of 2 of those. If you are lower in the covered period than the reference period, then you have a beginning of a reduction. So As our example showed, if you had an average of 10 FTEs during the reference period you chose, and if you have 8 FTEs during the covered period, then we're going to take 20% off your maximum loan forgiveness. We're going to say flat out you lose 20%. And if you take a look at the form, you'll see we compute that right away, we compute that right after we do the reduction for salaries and wages. But before we compare the 75% test. So there's some odd math there. That still continues. But essentially, this is how we do the reduction. Now, if that happens to you, how you compute these numbers, they make this very clear. So we have to go week by week, per employee per week on each of these calculations. Any employee that works 40 hours or more, by definition, regardless of which method you use for testing them, will be 1.0 FTEs. Somebody that works 48 hours is not going to be 1.2 FTE. No employee can be more in a single week than 1 FTE. So that's the cap at that point. When we talk about employees who work less than 40 hours, then we look at them by default initially as proportion of a single full-time equivalent employee. So if you had an employee, for instance, who worked 32 hours, right? 32 hours is 80% of 40. So they'd be considered 0.8 of an employee. Somebody who worked 30 hours would be 0.75. So we do those proportions. Now, if you don't want to mess with those proportions, or I should say, actually, let me get something else here. We did reject. A lot of people were wondering about, well, aren't they going to use 30 hours because that was what was in the Affordable Care Act? I never thought that had a legitimate chance of making it, but they did say here that they considered it, they rejected it, because 40 hours is more normal for full-time work, which I think is correct. So it's not 30. 30 is not allowed. It is 40. So make sure you're using 40 as your hours. They're not going to let you use that smaller number. Okay, now as we said, by default, we divide by 40, capped at 1.0 for employee per week. We do it on an employee basis. But if we go above that number, right, if they work less than 40 hours, now these are the people we have a choice on. So if they work less than 40 hours, we either divide by 40 and obtain the fraction I just mentioned, or we can simply decide that every employee that works less than 40 hours in a week is by definition 1/2 an FTE. And why would we do that? Might do it because it's better for us in the way the math works in the end, or we might do it that way because we don't have records of hours. So that's our only option, is to use it. But an important thing to note that they make clear here is there is a consistency rule, at least for the reference and covered periods. Now, where they talk about this, they never actually never said he had to be consistent when we were looking at, let's say the covered period versus the safe harbor periods, or, the makeup, restoring. I think you probably do have to use it for those periods, but I will say they only talked about the 2 periods in here. So if you have another period where FTEs matters, maybe you can change the methods. We're not sure. Now, reduction in salary or wages in excess of 25%, reduction in the loan forgiveness amount unless an exception applies. This gets a little weird, and we found out on the form. On the form for the reduction, if somebody's salaried, we took their annualized salary from the first quarter, right? We compared that to their annualized salaries of what they got paid over the 8 weeks. And if that had dropped by more than 25%, then we figured out how much that reduction percentage in excess of 25 over the 8-week period, what that computed. That's fairly straightforward. But what was more interesting was when we got to hourly employees. Hourly employees, we didn't look at what we paid them in the first quarter, except to look at what did we pay them per hour in the first quarter. And as long as that hourly rate was the same, even if their hours went down to 1/10 of what we had before, we don't have to worry about this reduction applying. So I could have cut my hourly workers down to nothing. As long as I kept their rates the same, I'm good. And you might have wondered why they do that. Now they offer an explanation. They point out here that if they actually dinged you for not paying the hourly workers as much in total, like we did for salary, annualize up and figure out how much we reduced, that would effectively be double penalizing you for reduction in full-time equivalents. Change in full-time equivalents doesn't really impact, it's not impacted by how much you pay a particular salaried employee because they're on salary. But changing hours, which would reduce FTEs, would reduce how much an hourly employee gets paid. So the answer they decided, we got to go with that for the hourly employees. Now let's talk about restoring, right? Remember, if we have, so we know we have one or both of the two reductions. We can actually, if we can restore the FTEs, we can get rid of the FTE reductions by June 30. If we can restore the rate of pay by June 30, then we can get rid of that reduction. So we discuss how we do this. Now, this rule is quirky for one reason. I kind of understand why they did it, why Congress did it. And it's a congressional thing. Do not blame the SBA for this. This was Congress. But this is mechanically how it works. First thing is, forget every period we've talked about before, essentially, because we're going to do two different tests. So all we care about is we did our first set of tests. We have a drop from the reference period to covered period, either in FTEs or in rate of pay salary or both. Having that, now we drop, forget all of those periods, and we go back and we start over to see if we can get out of it. The only way we can use the June 30 restoration first, though, is that one thing has to be true. If this is not true, we stop. We cannot fix the problem. We must have had a reduction in the FTEs or the salary or hourly wages that occurred between February 15th, 2020 and April 26, 2020. So effectively what we have to do is we have to figure out what were our FTEs for the payroll that included February 15th of 2020. What was our rate of pay for people during that period, and what was the annualized salary for everybody during that period. Then we have to go back and redo that calculation week by week for every payroll from February 15th through April the 26th, get our averages out of that. If the averages from that 15th to April 26th, February 15th, April 26th time period, are not less than what we got from that February 15th payroll, we're done. No way can you fix the problem. Right? You cannot use the safe harbor if you didn't have a reduction in that time period. Well, most people have a reduction there if they have the other problem. Yes, will everybody? No. There are going to be cases of people, and they could hire everybody in the state. They could hire everybody in the nation. They still could not fix their problem. So you have to understand that. You really want to know, is it even possible to have a restoration? Was there a reduction? So if we got a problem, can we even fix it? Did we have the reduction then? For instance, if you held off reducing salaries till after April 26th, it's not going to be fixable because the reduction in salaries didn't occur until after April 26th. And if it waited till then, there's no fix. I don't care how much you raise salaries by June 30, it won't get there. But let's assume you do qualify. If you restore either the salary and wage reduction or the average FTE by June 30, 2020 or earlier, then, now this is an all or nothing. If you get them back up to that level, we ignore the item that you did the restoration for. But it's all or nothing. You've got to be at that level or higher. If you fall 0.1 short on FTE, sorry, go back to the reduction. If you fall $1 short on annualized payroll, go for salaries, go back to the reduction. If you fall a penny short on hourly wage, go back to the reduction. So you have to get at or over. That's automatic. It's a cliff. Be sure you understand that. And it doesn't solve the problem in many areas. For instance, you're still going to have to find somebody to pay if you reduced FTEs or you reduce the wage and salary. That won't solve that problem, right? You're still short there in those areas. So, we have to be aware that this is not a perfect fix. That means you won't have any reduction whatsoever. It just fixes this particular reduction, but doesn't mean that you're going to get a full cancellation. If you do that, you can still end up short for a whole bunch of other reasons. Now, here's the other exception to your test. If an employee is fired for cause, voluntarily resigns, or voluntarily requests a schedule reduction, you'll be able to count their FT status before they left. So let's say we catch an employee in week 6 of the period and we catch them blatantly embezzling money from the company and we fire them. Okay, that's almost, regardless of what you think firing for cause is, if you catch them literally red-handed embezzling funds, they're writing checks, they're forging checks, they're to themselves, you've caught them, you've got absolute concrete proof. So let's assume all that's true. Because, by the way, all of that's going to be the fun part to prove. But if you have that, then what we're going to do is, if they were 1 FTE before you fired them, we're going to treat them as 1 FTE all through basically the covered period. Right? Same thing if they resign. This person's been working for you. Now suddenly they get a job offer in this market. Unlikely, but happens. And they go to work for your competitor, and you don't have time you can't replace them. You still get to count them. Similarly, maybe they said, I've been doing this. I've used up my 2 weeks for caring for, my spouse under paid leave. I have no more paid leave. So I'm going to ask you to reduce my hours. You can also then do that. Again, if employees request it, you're able to count their hours regardless, right? So it means they won't be harmed due to employee actions. That was the key for this one, right? That includes, like I said, being fired for cause, resigning positions, or requesting a reduced schedule. Any of those will not harm the employer. The employer will not be harmed by those issues. If you're going to use this, though, you've got to keep records. You got to maintain records demonstrating these are true. And if the SBA asks you or the bank asks you, you've got to produce those records. Now, the next IFR, it deals with the SBA's loan review. And this was what became the big deal when we talked about the issues regarding the, Ruth Chris, and we had the issues regarding the, Potbelly and the Shake Shack and all those issues. SBA review of loans. What is the SBA going to do if it reviews a loan? What are they looking at? And even if you won't be reviewed, this still becomes important because your bank may very well care about what's in this list. So let's take a look at what we've got, right? So first thing is they tell us right off they can review any loan, right? And they're going to review those over $2 million. Both of these were things we were told already before the program got started. So that's part of what we already knew. Now, what are some of the representations they are going to review? Well, here they are. They kind of list them in order. They're going to review borrower eligibility, right? They're looking at all of the reasons why you might have been eligible for a loan. Now, like I said, your representation on needing the loan, if you have an amount of less than $2 million, we won't look at that, but all the other requirements like 500 employees and using it for proper things, or having a proper need, not having already had other funds, not having another loan, all of those are eligibility issues. Any of those they could still try to trip you up over, even ignoring the fact that your need for the loan is not going to be questioned. That's not our problem. The next thing could be concerning to people where the bank gave you an amount that was greater than they should have. The administrator may review whether a borrower calculated the loan amount correctly and used loan proceeds for allowable uses. Now that's a two-pronged test. First thing, if you requested more money than you should have, that could cause the SBA to take action against you. So that's the first prong of this. But the second prong is, what did you use the funds for? Let's say, and this is the more likely scenario, you are not able to demonstrate use of the funds in the 8-week period, for forgivable expenses. Did you use them for the expenses that are allowed? And for the most part, allowed expenses are forgivable expenses The principal major exception is interest on debt not secured by anything. But you've got to show you used it for an allowed purpose. Now, probably an allowed purpose would include payments on like compensation or retirement plans amount in excess of $100,000, although maybe not. It's tough to know how they'll do it. But if your client does not have a loan completely forgiven, you still got to ask, did they use the funds for what they should have used them for? Because they're still responsible. It's not just carte blanche. They didn't give you this money. You could use it for whatever you want, and we just won't forgive it if you don't use it for the right stuff. No, you agreed to use it for the right stuff, so that could be a problem. Finally, they can review the loan forgiveness amount and review that form that you applied for forgiveness. Remember, when an SBA does a loan review, it's not merely for that form. You might think, well, that's what they're reviewing because that's the time they're going to review it at. No, that's just one of three main categories of things they're going to look at. Now, the SBA then goes on and tells us in this, how they do this? Well, they could undertake the review at any time. In fact, what they have here is, as they'll tell you, they have effectively up to 6 years. You have to retain the documentation for 6 years after the loan is forgiven and repaid in full. The SBA can review this up to 6 years from now. So there's an exposure up to 6 years of the SBA coming in and saying, we want to look at this. And you don't have a choice. You have to permit authorized representatives, including the representatives of the Office of the Inspector General of the SBA, to access your files on request. If you decide I'm just saying no, SBA can just say, okay, good, your loan is unjustified. You won't let us look to see if it is, so we're just going to assume it's not. And this isn't like tax law, where there's a tax court to go get things, where we can go fight for the next few years. You don't have to pay up. My guess is in this case, if you decide to play hardball here, you need to pay up. And then you're going to have to sue, and yeah, lots of things aren't going to look good. And the reality is you agreed to let them have a look at this stuff when you get the loan. Now, if the SBA decides you're ineligible for forgiveness or entitled to forgiveness, they could take any of the following actions. They could they're going to require the lender to contact you in writing to request additional information. So the SBA is going to say, lender, we're not sure these guys qualify for forgiveness, but we need some more information. The lender will contact you. As well, the SBA can go directly to you. So while they normally will ask the lender, they could come straight to you and ask for the information. So again, the SBA needs to know something to figure out what's going into this. Now, like I said, deciding I'm just not talking to you, I don't need to, it can result in a determination immediately you're not eligible for the loan or eligible to receive the loan amount or loan forgiveness. Basically, you don't play ball, you're guilty. So be aware, you're in this, you ask for something, you kind of need to stay around for it. Okay? Now, if you're filed for ineligible, you found to be ineligible, we talked about that directing. Oh, I see I've got this here duplicated. So, we're going to talk about how that works, but basically we have that forgiveness that gets disallowed. Now, can we do anything? The SBA says, sorry, Mary, your company is not eligible. Tough luck, pay it all back. Answer is the SBA tells us there will be an appeals process. So they are going to set up one, but we have no idea what it is yet. They're going to issue a new interim final rule. So we don't know about the appeals process. We do not know if you will have to pay up before appealing. We do not know if you can wait till the appeal's over. We have no idea. We do know there'll be a process. We don't know how it works. And we get that new IFR out, we'll worry about how it works, but until then, don't have it. The IFR also told us what lenders should do to review your documents. And lenders are told to review the following items, right? They should take a look at, okay, did they receive all the certifications in the loan application form? There's those series of things you're supposed to initial to say that you agree you did that. You don't fill that in, they're to reject the application immediately. That's the first take. Next, they need to get all the documentation listed on the application form that you were supposed to send them. So again, you've got to go through that checklist. If you leave something off, they can send it back to you or they could just disallow. So you need to give the lender everything that's in that list. That's what they're told to do. Finally, you got to confirm calculations. And what they're going to want you to do is the cash compensation, non-cash compensation, and compensation to owners on lines 1, 4, 6, 7, 8, and 9 on Schedule A of the application. Business mortgage interest payments, business rent or lease payments, business utility payments on lines 2, 3, and 4 of the main payment form, and review documentation to support those items. Again, you have to submit documentation to support those calculations. The bank is directed to review that. Finally, they need to confirm that they actually properly calculated on line 10 the loan forgiveness form correctly. Figure out if they actually limited, if you did the limit your forgiveness to an amount where at least 75% of the forgiveness amount is covered by payroll taxes. If that happens, great, we're good. Right? That's how we end up doing this. Okay, now the other thing we got to end up doing here as a lender, right? The borrower is responsible. So they tell the lender, you're responsible for checking that stuff. The following things are going to fall on the borrower if they don't do it properly. And the borrower is responsible for the accuracy of calculation of the forgiveness amount. If your client believes the bank's going to do that or that's who's responsible, not the way it works. They're responsible for the proper calculation of the amount. The borrower has to attest to the accuracy of the data on the application. As I mentioned last week, some CPAs were freaking out because it talked about the representative, attesting to the validity or certifying to the validity of information. This is very clear. The borrower is who attests. The borrower is the one who is attesting to the accuracy of data. They do not have to hire an outside CPA from an outside party. They are personally responsible for that attestation. So it's not something that the outside CPA is going to be doing. It's not something the outside CPA should even consider doing. That's different. The lender must make a good faith review of the documents, right? It's got to do a minimal review of calculations based on a payroll report by a recognized third-party payroll processor would be reasonable. This becomes important. What they have said is, we are going to allow you to be quicker, faster, not look as deep if you see a Paychex or an ADP report come at you. Recognized national payroll processor. However, if they don't use that, let's say somebody does their payroll in-house, the bank is supposed to do a deeper dive. This may be bad news for some of your clients because if they don't use Paychex or ADP, they're using a small local payroll processor or they're doing it in-house, don't be surprised if they're asked for a lot more data from the bank because the bank has been directed that a reasonable research, it has to go deeper if you're not using reports from a recognized payroll processor. Is that fair? I'd argue it's not. But does that matter it's not fair? Unfortunately, it probably doesn't matter that it's not fair. We're stuck with this. Now, as we mentioned earlier, there is a 60-day timeline for the lender to make a decision. They have to apprise the SBA of a decision not later than 60 days after they get a complete forgiveness application from the borrower. That caveat's important. They get to buy themselves a new 60 days every time they can show that you didn't completely respond to the application. It's going to be something like those applications for tentative refunds for NOLs where the IRS sends them back all the time saying you didn't give us everything and that restarts their 45 days. Same issue here. The bank can restart the 60 days by simply saying you didn't get it. You didn't give us what we wanted. At the end of that period, they do this. They either come down and rule they're approving it in whole or in part. They could rule they are disallowing the whole thing, no forgiveness whatsoever, or there's a third category here. Nice terms called. If they are directed to do so by the Small Business Administration, because the SBA has pulled your loan for review prior to the time that the lender decided to come after it, they can issue a denial without prejudice because the SBA wants to review your loan. Okay? What that means is you're not going to get an answer until the SBA process is done. Once they have ruled, the SBA has 90 days to then review that application. My guess is the SBA would say they don't, and here's the problem. If they gave you number 3, that they told you that your denial was a denial without prejudice, the SBA just affirms denial without prejudice until such time as they complete the review. If they're reviewing your loan, the likelihood is they have as long as they want to take a look at it. Okay, that's going to be their takeaway. Now, once they receive an action, right, they'll transmit, once they receive a notice they want to be reviewed, they're going to give the following information to the SBA. So if your loan is pulled for review, all of these things are going to the SBA. The application form that you gave the bank, the application you use for forgiveness is going to go in first. Next up, we're going to have the loan forgiveness application, right, and all supporting documentation, the application form and the application for forgiveness. If you receive that after you receive the notice they've commenced the loan review, you'll transmit those information within 5 business days of receipt. You also have to transmit a copy of Schedule A and must submit them within 5 business days of receipt from the borrower. Interesting aside here, note, the SBA can ask to review a loan even if you've not asked for forgiveness. Some may have taken heart thinking in the original announcement they made about the Shake Shack and Ruth Chris issue that as long as you didn't ask for forgiveness, there wouldn't be a problem because they were going to review you only when you asked for forgiveness. Well, they say anything above $2 million, we're going to review when they ask for forgiveness, but they never said they wouldn't review something that wasn't asked for forgiveness. They can do it. So your loan could be pulled for review even if you weren't asked for forgiveness. Okay? You have to have a signed and certified transcript of the account. That's a lender's issue to give them, right? And a copy of the executed note representing the PPP loan. And finally, any other documents of the loan that are requested by the SBA, they have to provide. So that data, like I said, is going to the bank or is going to the SBA, right? Now, the lender also shall not approve any application for loan forgiveness until the SBA notifies lender in writing that the loan review has been completed and presumably we're okay with forgiveness. So let's take a look at this. A lot has happened over this time frame, right? This is our second major set of guidance within the past week, and there's a good chance before we get into, the upcoming week that we're going to have guidance issued that's going to be coming at us with other items and other changes. And there's a reasonable chance Congress is changing the law. As we talk today, there are 2 separate bills, one in the House, one in the Senate, each one of which would radically change the program, both of which have the support of apparently the chairs of the small business committees, both of which have bipartisan support. The Senate one almost got passed before they adjourned, but that didn't happen. The House is expected to vote on theirs this week. We expect there'll be major changes, probably enacted not this week, but next week when the Senate comes back into town. So lots is going to be happening. If you think you know everything at this point about the program or how it's going to work, no, we are still in a state of flux. Look for a lot of new developments. All we've done at this point is caught you up. If you did not watch last week's broadcast where I talked about the application form, that's a very useful thing. You should really have been already aware. I kind of assume I did this. You're already aware of that form, but if not, you want to go back and check for that particular notice. It's on the YouTube channel that you can find it for the payroll protection program application form. Otherwise, check on your state society's website. We should be posted there, I would guess, in many cases as well with this stuff. This is going to be a mess, so be aware of that. Well, like always, remember we do every week do current federal tax developments that are happening, and this week I did that in addition to this, so we're going to have that background. If you have any questions or comments, send them to me, edzollers@currentfederaltaxdevelopments.com. You can follow me on Twitter. I'm at edzollers. I also participate in state society discussions for the state societies of Arizona, Minnesota, Illinois, New Jersey, and Washington. I'm on those. You can keep an eye on me there. I also watch for anything posted on the Reddit site /r/taxpros. I look in there from time to time, and Cal CPA's Tax Talk. So any of those we're good at. It's been a rough run, and we're going to continue to have things happening. This program is continuing to develop. Like I said, I can't say we're looking forward to what's coming, but it's definitely something we need to be aware of. So again, if you have any issues, just keep going. Watch for developments. Watch the SBA's website. Watch the Treasury's site for any new things posted. And not a bad idea, Like I said, I see a lot happening by following people on Twitter. There's a hashtag #tax Twitter where a lot of this gets cross-referenced when things happen. So if you know Twitter, you can go there. But keep up, and we'll hopefully be talking to you. If you have a chance, take one of our courses. We're still doing courses that do full updates on this. So if you watch your state society, see if we're doing an update, you can follow us there. Otherwise, have an interesting week. And as I said, don't expect we are yet done with all of the changes that we'll be seeing in the Payroll Protection Program loan system.